Hello and welcome to the latest Redwood Finance podcast. Today's question, as the regulators get tough, how can you prevent a bad audit? I'm Tony Hallett, writer and editor, and joining me again today is Adrian Li, finance transformation expert. Welcome, Adrian.
Hi, Tony. Good to see you again.
Great to have you here. So we'll start to get into this very big issue and one of the biggest challenges around audits, and with really the aim of answering this million-dollar question, or it could even be a billion-dollar question, I guess, in some cases. How do you prevent a bad audit? Now, the background to this is really the scandals and some of the stories we've seen in recent years around frauds and financial misstatements. And we know that this has a really big effect on an organization's reputation, especially around investors and key stakeholders. This is serious business. So all this puts more pressure than ever on the audit process. External auditors are focused on the quality of the audit they do and safeguarding their own reputation. And it means that if organizations have any chinks at all in their processes and controls, they can expect more scrutiny from compliance testing and substantive transaction testing by their auditor, which also, by the way, means higher audit fees. So I want to get to you and really talk about what the red flags are. How can you, as a finance team or CFO, get ahead of the problems? What robust processes and controls look like to your auditor. So in short, how can you prevent a bad audit? So to kick things off, we talk about how scrutiny by external auditors has got tougher. Why?
So really the pressure on auditors is to identify and call out issues that they find. And confidence in auditors has been severely dented by previous scandals, such as recent ones with Patisserie Valerie, Rolls-Royce, BHS and BAT, to name a few. And in many cases, these scenarios have resulted in auditors being fined. For example, PwC were fined $6.5 million by the FRC for its audit of BHS, and KPMG were fined $3 million for its work at Ted Baker. So really, the scrutiny is driven by the perceived quality or lack of quality in audits that have been happening certainly over the recent past.
Okay, so if you're a CFO, you're the finance organization, what does this really mean for you? What are the key challenges they face from an external audit process?
Yeah, so the key challenges from my perspective would be around particularly the audit evidence. Is this available for the auditors in the right format? So we're talking about the supporting documentation for journals, comprehensive audit trails and those sorts of things. Another key challenge is going to be, do I still retain all of the relevant controls in my processes that allow the detection and prevention of fraud and errors, and whilst ensuring compliance with policies and so on. And if that's not the case, if they're not there, one of the big challenges for the CFO is going to be, well, the auditor may need to do more checking of my accounting records than usual to gain the confidence they need, which may have an impact on audit costs for this particular year, i.e. they can increase. And the other big challenge for the CFO is going to be, can I prove that the numbers in my financial statements are complete, accurate, valid, and reliable? They're really the big issues and challenges the CFO will be facing from an audit perspective. And I guess coupled with that, it's going to be the time pressure as well on the team. At the same time as the audit work starts, quite often that's a busy time at either third quarter end or year end for the finance team as well.
So I'd like to bring in, Adrian, some of your personal experience. And I know all the way through this is you having seen things from all angles over your career. So please, tell us about any stories you have. But I mean, a bad audit has clearly got a number of serious consequences. Can you talk a bit more about some of those?
Yeah, so for example, if fraud is occurring and it's undetected, obviously there are financial consequences, both in terms of losses for the business, but also in terms of confidence in the company as a whole. If it's a listed company, There may be, when it eventually does come to light, that there's been a fraud that's been in play for a number of years, that could seriously dent the share value for a particular company. And I guess there's two ways of looking at this. So, some of the issues and challenges could be either through negligence. So it could be the fact that somebody doesn't know the process and they've always done it a particular way, and that's resulted in some errors, a material misstatement of the results. But equally, it could be fraudulent, and people tend to focus on the fraud because that generates the bigger headlines. But equally as bad are negligence through lack of knowledge of a process or lack of control to make sure things are done in the right way.
And it's not like any of them are a good excuse. I mean, these are all bad reasons, whichever way you look at it.
Yeah, exactly. Yeah, and as we've discussed before, Tony, finance teams heavily under pressure, a lot of manual effort, and quite often very reliant on temporary staff to supplement the teams to give bandwidth, coupled with the fact that a lot of the processes are not very well documented. So that kind of combination of factors often leads to issues and challenges in making sure that the finance postings, the finance results reflect accurately what's happening in the business.
And I think last time we spoke, we touched on some of the specific issues that we're seeing now with some of those teams, some of the shared service centers, personnel all around the world suddenly working from home, certainly not working under normal conditions. So it's a very tough act at the best of times. It's even harder, serious business in current times. So tell us about, moving on, tell us about some of the areas that external auditors focus on today that organizations can look to address.
Yeah, so the job of the auditor really is to make sure that the books of account really reflect accurately the performance of the business in a nutshell. So in order to do that, and in an ideal world, they'd want to be able to check every single significant transaction and make sure that they are accurately recorded in the books of account for the business. But in practical terms, particularly for big organizations, that's not possible. The volume of transactions is way beyond what you could do manually. Because let's be honest, a lot of the audit work traditionally has been manual. I remember my days as an auditor, both internal and external. A lot of the work we did was what they call tick and bash. It was very manually intensive work. So in the absence of being able to check every significant transaction that happens within a business over the year, what the auditor has to do is apply an intelligent testing approach. Foundation of that is to really test processes. So are the processes that are in place ones that have all of the controls, all of the checks and balances that are necessary to make sure that transactions are accurately recorded to reflect what's happened in the business? So that's first and foremost the foundation of the audit is an assessment of the processes. That's pretty much called in audit terms compliance testing. If the auditor finds that those process tests come up with maybe a mixed bag of results and there's some issues and challenges around processes, which can be typical in some areas, then what the auditor then has to revert to is more of a substantive test around the transaction, so a more detailed deep dive and walking through certain big transactions to confirm that the processes, although there are weaknesses, they still in the main result in accurate records being generated in the finance system. So that is the kind of the background of how the audit generally works. Third parties are also involved, so customers and suppliers are involved, and banks, and there is third party checks done on let's say balances that the company has in their books with those third parties too. So what's really key for the external auditor then with that as a context is what are the controls in these processes? What controls are in place to avoid errors and fraud? For example, is there segregation of duties? Or is it possible for one person in finance to actually manage, record, and orchestrate an entire end-to-end process, and then the financial impact of that. So segregation of duties is an important area and focus of the audit. And equally is adherence to policies. So are there people in the business or in finance who are actually authorising transactions either that are above their remit or for areas outside of their responsibility? So there's a number of areas from a control perspective that the auditor really focuses on. And really to underpin that, there is this kind of concept of audit evidence. So what the auditor is really looking for is what evidence is there to substantiate the transactions that are being tested in the system to ensure that they accurately reflect what has actually happened in the business, whether that's a sale, a purchase, creation of an asset, disposal of an asset, and so on. So the audit evidence is really key in this process too. Without audit evidence, you're then obviously having to go to senior people in the business or in finance and get them to effectively underwrite the fact that that transaction represents the reality of what happened in business terms.
Okay, I mean it's a complicated yet fascinating picture that you're painting there, with a lot of moving parts. I think we've established that, and we'll probably always mention that. But I want to get on to this idea of how can organizations address some of these issues you're talking about, especially how can they reduce manual journals and increase risk of fraud, other areas like demonstrating good controls and processes and providing that audit evidence that you've talked about. What are some of the ways forward?
Yeah, so first and foremost, one of the items you called out there, Tony, manual journal entries is a big area. If you look at a lot of the frauds that have been in the public domain, a lot of them have been made possible by the fact that significant manual journal entries have been able to be posted to the systems over in some cases quite a long period of time, multiple financial years, for example, in some cases. So manual journal entries is always a particular big red flag for an auditor. And I think really the solution here, actually for both finance and for audit, is in technology, because what we're seeing more and more, we said at the top of the conversation that audit work has traditionally been very manual, but we're now seeing more and more technology deployed by auditors in order to help improve the quality of the audit work. So it makes sense that technology should be more widely deployed by the CFO on the finance side as well, because that kind of matches up and aligns with the way the audit process is going too. So from an organizational perspective and how they address some of these issues, I would say technology is really important. Technology that brings better control through process orchestration, execution and monitoring of tasks, so that you know and the CFO knows exactly where they are in processes, who's doing what, using technology to handle the handoffs and handovers, but also using technology to enforce segregation of duties and adherence to policies, things like approval levels and responsibility and authority areas and the like. From a journal point of view, the big red flag we talked about, use of technology in that particular domain is really going to help in the preparation and posting of journals. Certainly from a preparation point of view, there is technology that can automate journals, production of journals, and then the posting of those journals to the finance system. So that technology will effectively eliminate a lot of the manual effort, which will eliminate some of the errors, but also the opportunity for fraud to be perpetrated.
Yeah.
And I guess a spin-off benefit from that as well is that the technology will also ensure that all of the requisite audit evidence and audit trails is available to make the auditor's job better when they come on board.
So technology is not the only answer, but a huge part of what's possible and best practice these days.
Absolutely, yeah. And I think technology then also enables sort of transformation of processes. So having taken the manual steps out that you can with technology, it then allows you to completely transform everything else that happens around that technology as well.
So drawing on your experience and what you've told us about today, What's the one thing CFOs should really take away from this? What would be the most important action that they could take?
So I think, Tony, really it's a kind of summary and reiteration of a point we just talked about, which is on the basis that auditors are investing quite extensively now in technology. And we're even looking at now auditors dipping their toe in the water with things like artificial intelligence, so they can start to look at the quality of the data within the books of the business they're auditing. It absolutely makes sense in my mind that CFOs should be very much looking at how they deploy technology to improve their processes, to enhance the controls, and to eliminate the possibility of fraud and error, as we talked about. So I think in my mind that's the single biggest takeaway that we could have here.
Okay, well, Adrian, this has been another great overview of a very big area of finance, and we look forward to drawing on more of your real-world experience and all the different angles that you bring to the table on this. It really is great to get that input. I think we've covered a fair bit of ground quite quickly today, as ever, skimming the surface, because there's a lot further we can go in some of these areas. We've really seen some of the big issues, whether it's through manual errors, mistakes, or fraudulent activity, and really how technology is a big part to play in joining up processes and giving the overview and making so many things possible. You even speak about the future and some of the cutting edge techniques that will be coming up for the audit. So again, I'd like to thank you, and for our audience, I'd like to say by all means, please check out the redwood.com website to find out more about finance automation in general. We'll be bringing you more of these issues over the coming weeks. Adrian, I want to say once again a big thank you to you. Until next time, this has been the Redwood Finance Podcast.